Forget the 4-year cycle. Joe McCann says Bitcoin could be trading at $150,000 within the next 90 days.
Bitcoin could be trading 150K by the end of this year, right? Could it go higher? Of course.
Joe is a founder of Asymmetric, the top performing hedge fund in the world in 2023. He's a former Microsoft Cloud and AI exec, a Wall Street quant, and a technologist who's been coding and trading since before most funds ever touched crypto. When people want the institutional playbook for what comes next, Joe is one of the very few voices that actually matter.
That begets this sort of notion that a 4-year cycle just doesn't matter anymore.
The models everyone has relied on are broken, and Joe explains why the cycle plays out on a completely different timeline.
As more and more companies, startups, corporates, et cetera, start to adopt something like stablecoin payments, they're going to have to own crypto on their balance sheet. It's just inevitable.
Treasury adoption is coming, and Joe breaks down which chains are set to win.
Everyone speculates on these things. Some people are going to get very wealthy off of it, and others are going to be left holding the bag.
And make sure you watch until the end to hear Joe's top undervalued altcoin pick.
I think they're just criminally undervalued. They generate, billions of dollars a year in revenue.
This is a hedge fund playbook for crypto's next leg up, straight from the guy who already proved he could outperform the world. So guys, stay locked in because this is an episode that could change how you trade the rest of 2025. Joe, welcome back. Good to have you.
Hey, great to be back.
So Joe, since we last spoke, not a whole lot has really happened. We are now in the very, very beginning of what we hope to be October. But where are we right now in the current cycle? Are we in this traditional 4-year cycle, or as Raoul Pal has kind of suggested that we are now part of this 5-year global liquidity cycle? Which kind of version do you subscribe to? Where do you think we're at?
Yeah, I mean, I have been in the 4-year cycle is over camp for years now. I think really it became the case with the introduction of the Bitcoin spot ETFs, and then subsequently all of the options that can be traded on the Bitcoin spot ETFs. In fact, yesterday I saw that the majority of volume and open interest for options trading in general is with iBIT, which is the BlackRock ETF, so more than Deribit. So that kind of institutionalization of Bitcoin and then subsequently crypto, I find it very, very difficult to see a 4-year cycle playing out like previous cycles. And a lot of that has to do with the way that these institutions manage the investments in these ETFs. And so as an example, BlackRock just announced the other day a covered call strategy ETF against their Bitcoin ETFs, right? This is a way of you're holding the underlying asset, you sell a higher strike call against it, you get paid premium to do that, and you collect carry in doing so. And what happens with that when you have that at an institutional scale, let's be clear, I mean, BlackRock, $12.5 trillion asset manager, iBIT being one of the most, if not the most successful ETFs in their history, you're going to have a lot of that, right? A lot of covered call selling just in this one product, let alone all of the other banks and asset issuers that are doing the same thing. And so what does that mean for the price of Bitcoin? And we'll just focus on Bitcoin and not the rest of crypto for now, is that when you have that much selling of volatility, you're dampening the overall volatility of the asset. And then furthermore, there are other option strategies like a caller, where you can sell the call and then buy a put, which kind of locks you in this price range and protects the value of that underlying asset. All of these types of derivatives and options trades that are being packaged and bundled by the banks and asset issuers and ETF issuers dampens the volatility of Bitcoin. And so can we have a day where Bitcoin is down 50%? Sure, but the odds of that happening are so infinitesimally small now because of the institutionalization of it, as well as the dampening of the volatility. And I think the last thing I'll mention as it relates to vol is if you look at what's called realized volatility, it's in a severe bear market right now. So if you just take year to date and you look at, a 30-day window of realized volatility or even a 90-day window of realized volatility, 30 days down 72% year to date, and 90-day realized vol is down 50%. And if you're a vol trader, and meaning long volatility, that's not good for your strategy, right? Yeah. If you're a vol seller, that might be better because you're getting premium that you're collecting by selling this volatility because you're short volatility effectively, and that begets this sort of notion that a 4-year cycle just doesn't matter anymore in the traditional sense, whether it's using the halving, et cetera. Like, it just doesn't apply. And as more and more of this kind of volatility selling or dampening effect comes from the institutionalization of Bitcoin, you're not going to see waking up one day and seeing Bitcoin down 50%. I mean, you would have to have a true tail risk, Bitcoin stops producing blocks, something so extreme that it kind of doesn't matter. It's just not going to happen anymore given the institutionalization of Bitcoin.
Can you just break it down a little bit more for us on the new product that iBIT is offering? How does that affect the volatility or spot price? Is there any exposure to underlying asset, or is that just puts and calls kind of thing? Just guessing.
Yeah. So conceptually, a covered call is where you own the underlying asset. So let's say you have $1 million worth of Bitcoin,
okay,
and then you want to sell, say, an end of 2025. So it expires at like the end of December. Let's say Bitcoin is trading 120K, and you sell 130K end of the year call. By selling that, you're collecting, someone is buying it from you. So you're taking in that money, right? But you're on the hook to deliver the underlying asset if the price of Bitcoin goes through the strike price, meaning 130K, right? Mm-hmm. So the reason that it dampens volatility is that if I'm just an individual person and not a lot of people are selling vol, it's not going to have that big of an effect. When you're shorting volatility, you're selling it, right? So if somebody's shorting a stock and they're shorting and shorting and shorting and shorting, what happens to the price? It goes down. So if you think about volatility like an asset, right? Just like if you can buy gold or Bitcoin or Apple stock, whatever, those are assets. Volatility can be an asset. And so as more and more volatility is sold, you're effectively shorting volatility. There's a ton of people selling it. It dampens the overall realized volatility of the actual asset, meaning it doesn't trade, these crazy swings, right? Like we've seen some tokens recently launched, like Aster and Plasma, have had insane swings intraday, let alone day over day.
Yeah,
that's not happening to something like Bitcoin because of the way that these covered call strategies, just as one example, work. So what is iBIT or what is BlackRock doing? They're basically going to investors and saying, hey, instead of you buying iBIT and then going into your brokerage and selling a call and then having to manage that yourself, we're just going to manage it for you. We're going to buy iBIT, and then we're going to sell iBIT options against it and collect that premium. Now, imagine, if you look at like the amount of AUM of iBIT today, it's enormous. Yeah. So take some percentage of that and say, if they can actually offer this covered call strategy ETF, income generating strategy ETF, to people that, bought iBIT, 10%, 5%, 50%, whatever it is, that is a significant amount of call selling and volatility selling. And so this gets into more of like how the market makers and the dynamics and mechanics of the markets actually work. If you have a lot of people short calls, then you have market makers long calls. And if the price moves up, market makers are going to have to delta hedge. And then that can actually, clamp down the volatility of the asset itself, meaning how much it swings. And so the point here is that if you have someone the size of BlackRock selling vol at scale, that is going to dampen the kind of upside and even downside price swings of something like Bitcoin.
Okay, so the original question was back about the 4-year cycle, and then you think that that's no longer an issue because of these kind of things. What about when we move beyond Bitcoin?
Yeah, so I think that if you take kind of Bitcoin out of the equation, and you look at, let's just say, large cap alts. So these are going to be your Ethereums, your Solanas, your BNBs of the world. The sweeping changes in the regulatory environment are what I would consider open season for crypto assets, non-Bitcoin crypto assets. And that is enabling things like more ETFs to be issued, right? So I think there was something passed the other day from the I think it's the CFTC or the SEC. I can't remember which one, but basically it's like it's SEC generic filing for tokens for ETFs, and all the Solana ETF, spot ETF, folks that filed pulled those filings and then refiled based on this new regulation or rule, if you will, for how to file basically a generic ETF. I mean, that effectively means any token, for the most part, could be wrapped up and packaged as an ETF. And so we're seeing this this move towards assets that are in crypto now being ETFified very, very easily. Furthermore, I think if you look at what's happening around stablecoins, and I've been saying this for years, that's the killer app for crypto, whether people like it or not. It really is. I mean, Tether is raising $500 billion at a $20 trillion valuation. It's just crazy. I mean, the amount of money that's flowing into stablecoins is huge. But more importantly, you're seeing companies like Stripe, which at one point were anti-crypto, now offering, hey, stablecoin as a service. Anybody can create a stablecoin. And by the way, you keep all the yield. You determine how that yield is shared with either your users or you keep it yourself or whatever. Whereas if you look at Tether and Circle, which I'm an investor in Circle, they more or less keep the majority, if not all of that interest that they get, right? Yeah. That also begets the underlying protocols or the blockchains that are powering. So, for example, Stripe recently launched this thing called Cash, which is the stablecoin as a service. The first endpoint is working with Phantom Wallet. They launched it on Solana. Why? Because it's super fast, it's dirt cheap, etc. This does not imply that stablecoins won't have an impact on Ethereum. I just don't think it will be as material. But at the end of the day, as more and more companies, startups, corporates, etc., start to adopt something like stablecoin payments, they're going to have to own crypto on their balance sheet. It's just inevitable, right? Mm-hmm. Now, one could say that, hey, Stripe could just abstract all that away for their end users and their customers. That means Stripe is going to have to acquire more crypto, right? And then if you put in context the kind of the speculation associated with owning any of these assets, which ones do you want to own in size, assuming that we are starting to see the proliferation of a ton of like consumer apps and enterprise-related applications just using stablecoins. We can talk about other types of applications later. If you speculate on that and you look at which ones will likely benefit the most, it's going to be the ones that are going to be having the most activity. And yes, I've been a long-time Solana bull. I still am. I think Solana benefits the most from this. It's about 20% the market cap of Ethereum and is dominating, on-chain activity across every chain. And if you include L2s, it's the same thing. That being said, Ethereum has clearly broken out. I actually got long it back in May. I was super bearish on it all year. It broke out. It's been maintaining, price above 4,000. It clipped a new all-time high briefly. I do think that there is upside in Ethereum, but not so much so because of the amount of activity that's going to be associated with, say, stablecoin issuance and transactions, more because it's going to operate as like an institutional or enterprise settlement layer. And settlement doesn't need to be fast. It doesn't even need to be cheap. It just needs to work. And so I do think there's a case to be made that, Ethereum still has upside in it. But I do think that Solana will ultimately outperform something like Ethereum, just given the size and scale of the network activity that's on it today.
Yeah. So, and then to answer your question of like which one will people like Stripe and everything hold? Well, they're going to be holding in the reserves the asset that they are finding themselves using, right? So it's going to be Solana and
yep.
And
like, I mean, look, assume Stripe puts, I don't know, $1 million worth of Solana on their balance sheet. That's a lot of transactions, right? Yeah. But so it's not to the extent that like hey, Stripe is going to have $1 billion worth of Solana on their balance sheet. They might, but here's where I think it gets more interesting is that I have a portfolio company that will go unnamed right now that is doing these sort of, they've been doing kind of enterprise managed services for Solana applications and infrastructure. And I do think there's a case to be made that, yes, I know Stripe is building Tempo, which is their L1 for stablecoins, but there is a case to be made that folks like Stripe or other companies will end up needing to own kind of the vertically integrated stack for just stablecoins. Well, what is a vertically integrated stack? You're going to need to run your own Solana validator. Well, if you're running your own Solana validator, you're going to need to have a significant amount of stake, which means you need to buy a lot of SOL and stake that. That means you're also going to need to be able to have high performance RPC infrastructure. So you would either do that yourself, or you would, say, partner with unnamed portfolio company or acquire them, right? So I think one of the things that we'll end up seeing is, particularly as it relates to payments, you will see companies vertically integrate across these chains, and they may choose to do something with Solana and Base, right? And so now they need to vertically integrate for like the for Base ecosystem, whatever that may look like. But if you look at Solana specifically, owning that entire infrastructure and tech stack improves your how fast you can land transactions, how many more times you're in what's called the leaders schedule. So you get more, you get to you're basically producing more blocks at the beginning of each schedule every like 400 milliseconds or so. This means you earn more revenue on those transactions and the stake that you have in your validator, et cetera, et cetera. So I think that is a path that will take some time, but ultimately you're going to have an edge when it comes to this. And if you aren't vertically integrating, your enterprise solution, if you will, you're offloading a lot of that to third parties, which could eat into margins. It also introduces, forms of risk that these companies may not want to take.
Right. So back to the question of kind of where we are in the cycle, and we now talked about the majors. It's obviously been a very, very institutionally led kind of bull market so far. I think at some point last year, we saw some kind of some retail coming in. We saw the Phantom Wallet and Coinbase apps climb up the ranks. That was short-lived, and we haven't seen it return since. Do you think that the economy and retail and your average person are in a state where we could get another retail FOMO-driven kind of parabolic stage in the next 1 to 6 months or something?
Yeah, I mean, I've been sadly the guy saying I don't think there's an alt season until Bitcoin dominance tops, and it kind of looked, maybe it still looks like it has topped. As it relates to retail, I think there's a bigger kind of philosophical, if not conceptual, issue here. That concept is really just attention. So, speaking from a U.S. perspective, folks that would be considered retail are gambling on sports. They're gambling, playing blackjack. They're gambling on prediction markets. This all these are forms of trading at a very high level, right? Yeah. Because you're putting money at risk with the expectation of a return on that. That is taking attention away from speculation in things like crypto assets. Now, if you also look at the stock market, some stocks have just absolutely ripped that have nothing to do with crypto, right? So if you look at obviously the AI stocks, but if you look at nuclear energy stocks, if you look at defense stocks, even the old meme stocks have been starting to rip. That is a lot of retail driven activity. And I actually saw a chart today that shows that, call option buying is at an all time high, and it keeps hitting new all time highs basically every month for like the past, since effectively January. This is all a retail, this is retail investing in this, right? Or trading this. And so how does that transition over to something like crypto? Yep. I'm not entirely sure, because the challenge really is the attention. How do you garner the attention of retail traders and investors to take their focus away from gambling on football or gambling on, prediction markets to speculating, aka gambling on things like, altcoins or meme coins or shit coins? It's a real challenge. Now, if you look at something like Pump.fun, forget the token for a second. They are doing something incredibly ambitious, which is tapping into the kind of the power of streaming right now. And, I'm an older guy. Like, I didn't grow up in high school streaming on my phone and doing Twitch and TikTok, these types of things. That is how, young adults function today, right? Like that's just what they're used to. And so if you look at the amount of value that's been created from streamers like Chasse, et cetera, I mean, the amount of money these folks are generating is enormous. And they're on these kind of, call it closed platforms like Twitch. Pump has an opportunity, I think, to actually break into that and say, hey, here's an opportunity for you to not only do, wild, crazy stuff while you're streaming, which a lot of these folks do to garner attention and go viral, but there is actually a currency associated with it that not only you benefit from, but your potential audience. It's a very bold and ambitious plan, but it taps into that point that I'm making about how do you capture that attention? That's the hard part. And so is there a potential that retail steps in over the course of 1 to 6 months? Absolutely. I mean, I think if you look at it from a macro perspective, the doomers have just been wrong all year long as it relates to the stock market and foreign trade policy, these types of things. None of it is actually real. I mean, you have stock markets hitting all-time highs, yet sentiment amongst investors is still pretty bearish to neutral. You don't have that when you're at a market top. And you're now entering a Fed cutting cycle. Well, what happens when the Fed starts cutting? People move further out the risk curve. This is, everybody knows this. You're going to have the money supply expansion. Raul's a friend, and I get why he kind of put that model out there to say this is a 5-year liquidity cycle. I think that does make sense. I'm just not moving the goalposts, right? Like if you believed in a 4-year cycle for Bitcoin, or if you believed in the expansion of M2 money supply or global liquidity in general, a year and a half ago, we should have already peaked by this time this year. Now we're just saying, hey, things are different, which is good. You have new information and you reassess, your framework. But if you add all this together, it's very challenging for me to see a scenario where the U.S. economy, let alone the global economy, collapses or has some severe depression before the end of the year. Ahead of a cutting cycle. Yes, employment numbers are getting kind of tight in the United States, but those are solvable through cutting, which is the Fed is absolutely going to do and continue to do. And then that creates a credit cycle, a credit boom, where banks are actually lending to small businesses, and that also bolsters the economy. All of these things put together, you say there is a strong chance that retail could come in and start buying a lot of these crypto assets, and we could have a pretty nice run for things that are non-Bitcoin related. I get back to the issue of attention and how do you actually capture that given so many other opportunities for folks to gamble or, invest and make money. That's going to be the big issue.
Yeah, attention's hard, especially when you bring up something like Pump. It doesn't seem to be bringing, like, from what I've observed, there's nothing about Pump that is value generative, at least not for the general market participants. It's right, maybe the creator makes some rewards, Pump makes their revenue, and that's more money taken out of the ecosystem, right? I mean, Pump made, probably by now, I don't know what it's done, but at the time of the fundraise, I think I generated $800 million in revenue that went to that was from potential retail investors that could have gone into prior cycles, would have gone into altcoins or something like that. But that was just everyone hoping to become rich, right, on meme coins and losing their money at the casino.
Yeah, I mean, for me, the way that I interpret this with Pump is less about, the revenue that they're generating or how creators are generating revenue. It's more about how are you now onboarding or bringing new people into crypto. And so if you go back to, if you go back last year when you had the Cambrian explosion, if you will, of meme coins, that brought people in. President Trump launching his meme coin in January, that brought people in. So meme coins, you can love them, you can hate them, you can say they're good, you can say they're extractive. It doesn't matter. It's an onboarding exercise, right? What I'm suggesting is that there's a chance that Pump, with their streaming capabilities that they're competing directly with TikTok and Twitch, could be another onboarding exercise. Does Pump benefit from that and generate more revenue? Probably. But my point is, like, if you start to get more people involved through something like streaming, especially young adults, you may have those folks become retail traders and investors in crypto. You may not. But I think that it's a worthwhile exercise and experiment to see if Pump can actually pull this off.
Yeah. I don't see it happening with Pump. Me personally, I just don't see how that because the fact is that outside of the inner circles, do you know anyone that's actually made money on anything that's ever launched on Pump.fun? Your average person, right? They come, they get interested in the get rich quick, and then they lose money, then they leave the casino, right? This is what we've seen, since the beginning of time. But I'm curious now on to get your thoughts on digital asset treasuries. We had an explosion of those. They were doing quite good. It seems like for now, and it could just be because we've had this lull in the market, low volatility, things got a little bit boring. But do you see those as beneficial for the space overall? Are they going to continue to grow? Are we going to see a lot more being formed? Or have they seen their days? How do they differentiate? What's your thoughts on them in general?
Yeah, so I was pretty close to this earlier this summer, and my view hasn't really changed. I think, number one, as long as the debt markets are going to continue to reward folks like Michael Saylor to be selling vol and using that to buy more Bitcoin and increase Bitcoin per share, these are going to keep coming. And I think that the other thing to note here is that this is a global phenomenon. This isn't just the United States. A lot of these are, in Hong Kong, in Japan, Singapore, the Middle East, Brazil, et cetera. What I thought months ago and what is actually already starting to happen and will continue to happen is, in order for these DATs to really work, I think you're going to let's just focus on Bitcoin, Ethereum, and Solana. You're going to have a scaled leader for each one of those major assets.
Right.
If you look at Bitcoin, that's Strategy. If you look at Ethereum, I think right now it's Bitminer, could be SBET, somewhere, depends on how you look at it, but it's probably Bitminer with Tom Lee. And then if you look in Solana, it's probably the Galaxy Jump multi-coin DAT, just because of its sheer size. They will need to maintain those leads to be successful. Mm-hmm. And the way that can happen is through M&A, right? So what's wild is a lot of these DATs are trading well below a 1x MNAV, meaning the net asset value of the assets on their balance sheet is less than the market cap of the company, right? So in simple terms, let's assume you have $100 million worth of Ethereum on your balance sheet. And the market cap of the company, that's the price of the stock times the amount of stock that's out there, is 50 million. You're trading at a 0.5x MNAV, right? You literally have on your balance sheet $100 million worth of an asset. The company's worth 50 million. That doesn't make sense, right? No. Except multiple DATs are trading below 1x right now and have been for quite some time. And so what my view was you're going to have consolidation from the scaled leaders to come in and acquire those companies because they're trading at such a discount to their MNAV. And why would they do that? Well, assume a company is trading at, like I said, $100 million of ETH and $50 million market cap. Yep. They could come in and buy the company for $75 million. So that's a 50% increase for the share price, but it's still at a 0.75x MNAV. Now, all of a sudden, the acquirer, the company that's acquiring that smaller company, gets all of that Ethereum on their balance sheet at a discount. They just basically bought $100 million worth of Ethereum for $75 million, right? And we're starting to see this now happen in Bitcoin, right? So Strive, which is the ticker ASST, Bitcoin Treasury company, went and bought Semler. And they saw an immediate 15% increase in their MNAV because of the discounted Bitcoin that they were able to acquire for that price. That's going to start happening more and more and more. And it has to, because the smaller kind of non-scaled DATs are not going to be able to compete with the larger ones. And if you look at, say, like the Solana DATs, the reason that this matters is the way that you earn money or income from, say, running a validator and staking your SOL, which all of these DATs are. They're either running their own, very few of them are because they don't have the technical acumen to do it, or they're kind of partnering with validators out in the space, is that if they have a sizable amount of stake and they're in a validator with that, they end up with more transactions that they get to process, is the easiest way to think about it. It's in what's called a leader schedule. So by having that economy of scale, meaning a ton of SOL staked, you will earn more than your competitors. So if you're a subscale DAT with say $100 or $200 million worth of SOL, you're just simply not going to get the same type of yield and ultimately revenue in SOL terms as a larger one. It's just simple math. So what will then end up happening? Well, the folks that are larger are going to generate higher yield. They're going to generate more income. The ones that are smaller will not, and the market will punish them for that because they'll look at the competitor and say, hey, this person or this company, I should say, is generating this yield in SOL terms, and you're not. Therefore, I'm going to long them and short you is like kind of the easy way to think about it. So then the scaled ones come in and say, we will now acquire you. So I think number one, you'll continue to see. I mean, we saw another one announced today for Solana right before we were shooting this. You're going to see, I think, more and more of these. You'll start to see the longer tail of assets as well, because there's already, there's a BNB one, there's a Hype one, there's I think there's an Athena one. There's lots of them are coming out, and will they all work? No idea. This is again a very crypto specific thing, or not crypto specific, but crypto consistent thing, which is everyone speculates on these things. Some people are going to get very wealthy off of it, and others are going to be left holding the bag. But I do think the difference is if there is a DAT that someone is invested in, of course, this is not financial advice, but if you are invested in a DAT where someone invests in a DAT and it's trading below a 1x MNAV, that thing is an attractive acquisition target. The thing that's holding back a lot of acquisitions and M&A right now is, one, obviously these companies are very new, but two, there's not a lot of willing sellers. So the folks that even have low MNAVs right now, they don't want to sell, right? Because in theory, if we do get a ripping bull market in altcoins, you will see the value of the stock rise. And in theory, these things trade closer to at least 1x MNAV. So why would they want to be selling now? I think, 6, 12 months from now, if these companies are still trading well below 1x MNAV, and we've had a rally in crypto, those are going to get picked off left and right.
That's interesting. It kind of gives me a bit of an answer to the question I was going to ask you next, but I'll let you dig into it a bit more. Is, do we have like a fundamental structural risk involved with these DAT companies if we go into some sort of 80% correction of these altcoins, the Solana, the BNB, the XRP, whatever these DATs consist of? Let's say that we get into a big correction. Are they liable to have to dissolve and liquidate these assets and sell them on the market, or do you think they'll get acquired, or like is that a big macro risk that we're blindly ignoring?
So, I mean, the if the framing is, let's assume, say Solana drops 80%, over the course of like the next 6 months or something, right?
Yeah.
If somebody's MNAV stays exactly the same, their SOL per share is exactly the same, right? It doesn't change. Now, the price of the stock should trade down 80% if it maintains a 1x MNAV. I think that the issue with, is this a systemic risk or a black swan or tail risk, a left tail risk event that we should be aware of? Yes, but it's very nuanced. So, for example, if you have DAT A and DAT B, and they both have, say, $500 million worth of SOL on their balance sheet, the question is, how did they get that $500 million worth of SOL?
Right.
Did they have did they do some loan or debt deal that is very punitive to them, right? Maybe it's a high interest rate or whatever, right? Are they over levered on the debt side of their balance sheet? Those, and let's say DAT A is that. If DAT B has favorable terms, they should do better in a drawdown like that, right? Mm-hmm. And this gets back to my M&A discussion, right? So if, for example, a company has, horrible terms on their debt, as an example, that company that has a stronger balance sheet, stronger terms, could actually go to the debt markets again and say, hey, we want to buy this company and kind of refinance their debt because we're a stronger business and we have better capital markets access, et cetera. This is very standard TradFi stuff. And that can be applied to the M&A deals for the companies that say are over levered or just have really terrible terms as it relates to their debt. So it's very nuanced because it's DAT specific. If you have an 80% pullback in Solana, all of these stocks are going to get crushed, but so are Solana holders. You're down 80%, right? I mean, that's just the nature of holding an asset that's down 80%, right? So really it comes down to the health of the balance sheet and the management team's ability to actually go into the capital markets and potentially refinance the debt and or do M&A related activity with favorable terms for the M&A that they're going to end up doing. So is there a risk? Yes. I mean, there's a risk that, Bitcoin stops producing blocks too, right? And so you should factor it in. But at the end of the day, if you're long Solana and it's down 80%, you're down 80% in SOL terms anyway.
Yeah. Let's go. Let's switch over to the assumption that we do see an altcoin season coming up. I obviously we know that you're very bullish on Solana. What else? What other? Do you have any other big bags?
Yeah. I mean, I have a lot of long-term holdings. I mean, obviously, I was the big bonk trade a couple of years ago. So I'm still very long bonk. I think that, bonk is, my understanding is that there's a DAT coming for them. If there's not one already out, I can't remember actually. There's supposed to be an ETF coming. So I think that the blue chip meme coins will have their day. And so obviously there's going to be some new meme coins that come out there. I stay relatively concentrated in majors, mostly because of the drawdown and the volatility. It makes it a lot easier to trade. As it relates to the longer tail of alts, I have a number of portfolio companies that I'm still very bullish on. Some of them have issued tokens. I think Jito, for example, I've mentioned them a number of times. I'm a big investor in them. They have just been consistently shipping incredible engineering capabilities that just basically no one else in Solana is able to do. And they have an enormous network, meaning, call it, I think it's roughly 90+% of all validators run Jito. Now there's competition. There's other folks that are trying to do Jito-like things in a different way. And I think that's healthy and good for Jito to continue to, compete. But I think they're just criminally undervalued. They generate billions of dollars a year in revenue, and the token's been a I don't know 40-cent range from $1.60 to $2 for 6 months. It just doesn't make any sense. But that's also the case for a lot of other tokens that are generating real revenue. And this this gets back to my point about attention. Is that a lot of people don't care if you're generating revenue. They want to know if it's going to be the next 100x runner, right? I do think some of the upcoming airdrops are going to be interesting. So there's a project called Hilo on Solana. I have been using them from day one. I think it's probably one of the most novel DeFi primitives ever. And the reason I say that is Hilo is a project where you can deposit Sol, USDC, Tether, etc., Jito Sol, and it will mint X Sol, which is a levered version of Solana. So you're getting 2x. Usually it's around 2x, but it can go up to 4x, 2 to 4x. It kind of modulates based on some underlying characteristics of how the protocol works. But you can get levered exposure to Solana. So if you're just holding Sol, you can mint X Sol and get effectively 2x leverage. And you say, well, wait a second, now I'm levered, I may get liquidated. They have the way that they've designed their system is that there's no liquidation risk and there's no funding rate associated with this particular asset. So at first, I'm like, this is way too good to be true. And then I dug into the docs. I looked into the source code on GitHub and was like, wow, this is actually really clever and novel. And since then, their TVL has ballooned over the past couple of months. I mean, it's a really, really new project. But you're getting levered Sol exposure with no liquidation risk. So
HILO?
HYLO.
Okay.
So I think, something like Hilo, they're, And yes, I mean, full. I'm not an investor. I just use the project or use the protocol. I'm very long XSOL. They're going to do an airdrop at some point because they have a points campaign that they're running. So I think that token could do really well. And also, if you look at kind of what happened with Aster, if you look at what happened with Plasma, new token launches, especially ones that are airdropped, are going to have airdrops. They have done really well in a short amount of time, right? I mean, Aster's still up significantly, Plasma's still up significantly if you did the private sale or whatever. I think you're going to see a lot more of that. And Q4, I don't know why it tends to be airdrop season for some reason. It just seems to be like the best time to do airdrops. And so a lot of the stuff that I'm looking at, of course, farming a little bit of the Aster airdrop. That token is obviously already out. Big hyperliquid competitor, in fact, Binance competitor, which is odd because CZ is favoring it as a DEX. But I also think something like Hilo, and then with Hilo, you can start to integrate it into other protocols that are also running points campaigns. So this is like Loopscale, this is RateX, this is Exponent. These are all projects that, if you mint XSOL, you could go to something like RateX and park it in there and earn a fixed yield in XSOL terms and farm points on RateX. The same thing for Exponent, Loopscale, et cetera. So for me, I look at kind of maintaining a pretty strong, portfolio of majors, favoring something like Solana, given I think it has a lot more upside than ETH. BNB surprisingly has just crushed it this year on a relative basis for alts. I think there's still a lot more upside to BNB. But then I look at some of the new protocols and projects that have launched this year / last year that are running airdrop campaigns or points campaigns, and I think that there's an opportunity to not only capture some value out of those airdrops, but also trade those tokens when they actually come to market.
So the attention from the airdrops is there. That's the game, right? So how do you get attention?
Yep.
Yeah. So let's say that we do have a cycle top in the next 6 months or something like that, at least for altcoins. Where do you see the top for Solana, Ethereum, BNB, Bitcoin?
I love these questions because I'm never a fan of price targets, but I love to give them anyway. So I think so. My framework for Bitcoin is it's largely has to do with flows, and so right now, it's October 1st. It's the beginning of Q4. Gold is on an absolute tear. Right. Especially ahead of a Fed cutting cycle that's not going to stop until some point in late 2026, in my opinion. Gold trading where it is now, if you historically look at the correlation between Bitcoin and gold, when gold runs, Bitcoin eventually catches up to it. Yeah. And we may be starting to see that now. October is seasonally a fantastic month for Bitcoin, if not the best month, one of the best months. And there's a lot of catch up to do with gold. Gold made a new all-time high overnight with the government shutdown news in the United States. That's a lot of, there's a huge spread between the relative performance of gold and Bitcoin, even year to date, let alone over the past, few months. So Bitcoin, if you just use that, it's a very simple heuristic. Bitcoin could be trading 150K by the end of this year, right? Could it go higher? Of course. I mean, the challenge that we face, and I think that this is the part, like there's a lot of crypto native metrics and indicators that people will use to try to, thread the needle on a target for Bitcoin. And a lot of that's like, well, how much Bitcoin is on exchanges that's available, right? If we get through this level, there's no Bitcoin available. And it's like, right, except for the fact that the institutions are now writing call options and have all these ETFs and these derivatives that are associated with it. That doesn't matter how much Bitcoin is actually on exchange. That mattered 3 years ago, doesn't matter anymore. And so the challenge will be, as institutional traders and investors are seeing Bitcoin, say, hit a new all-time high of let's say it's 130K, do they pile into that trade, or do they take profits or sell, volatility against it to capture more yield? That's going to be the challenge for something like Bitcoin. I think stuff like Solana and Ethereum, my framework is very simple. The higher Ethereum goes, the higher Solana should go, assuming Solana trades at parity or even at 50% market cap of Ethereum, right? So if Ethereum goes all-time high, roughly 5K, let's say it doubles to 10K, if that should imply, just very basic heuristic, that Solana should double, right?
Yep.
But if Solana encroaches on like the market cap ratio of Ethereum, it should go even higher, right? So my perspective is, I think Solana, if Ethereum goes to 10,000, like, hey, God bless, let's make sure it happens. My Solana bag should do significantly better if I'm right on saying that it is undervalued at 20% of the market cap of Ethereum. So if it goes to say 10,000, Solana's got to be trading north of $500. It would be. I mean, I could be dead wrong, but it would be odd for it to not be trading significantly higher if you encroach at all on that market cap. So I do think, like, Bitcoin, if it gets to 150K, you probably see Ethereum. I don't know if it gets to 10K, but Ethereum definitely new all-time highs, like 6-7K at least. Yeah. And then ultimately Solana should definitely eclipse that 300 handle that we got close to in January. And I think the first stop, which would be very consistent with crypto, would be at 420, which has been my target for a while. I just think that it becomes a magnet for the kind of mimetic culture that we have in crypto to go to that price target.
Yeah, it makes a lot of sense. Cool. All right, Joe, thanks so much for coming back, man. Really appreciate it.
Yeah, my pleasure. Anytime.